In March 2000, a programmer in Silicon Valley turned down a job offer worth $12 million in stock options. His friends thought he was insane. 6 months later, those options were worth $400,000. By 2002, the company didn't exist. He survived because he understood something most investors never learn until it's too late. Howard Marks calls it the cycle, not a pattern you observe, a force you're inside of right now, whether you know it or not. And here's the uncomfortable part. Understanding the cycle won't tell you when to buy or sell. It'll do something more important. It'll show you when you're being lied to, by the market, by experts, and mostly by yourself. Howard Marks didn't become a billionaire by predicting crashes. He became one by watching everyone else fail to predict them, then asking a different question. Not what will happen next, but where are we in the story right now? Because markets don't move randomly. They move in chapters, and every chapter has been written before. The problem is that when you're living through chapter 7, it feels like chapter 1. When you're in a bubble, it doesn't feel like a bubble. It feels like you finally figured it out. Like this time is different. Like the old rules don't apply anymore because of technology or globalization or some fundamental shift in human behavior. Marx has watched this story play out for 50 years. .com, housing, crypto. Each time the actors change, the script stays the same. And the script starts with something deceptively simple, psychology. Here's how the cycle works. It begins in fear, real fear, the kind that comes after a crash, when portfolios are cut in half and financial advisors stop returning calls. In those moments, investors want safety, bonds, cash, anything that doesn't move. So risk assets, stocks, real estate sit there, ignored, cheap, offering incredible long-term value that almost no one wants to touch. Then something shifts. Maybe earnings reports come in better than expected. Maybe unemployment drops. The news stops being apocalyptic and starts being just bad. Not good, just less terrible. And a few investors, the ones Marx calls the first movers, start buying. Not because they're geniuses, because they're willing to feel uncomfortable. They buy when it still feels wrong. Slowly assets start rising. 5%, 10%, nothing dramatic. But enough that other investors notice. The ones who sat out the crash start thinking, maybe I should get back in. This is where it gets interesting. As prices rise, something psychological happens. The pain of the crash fades, not completely, but enough. Investors stop asking, what if I lose money? And start asking, what if I miss out? Fear of loss becomes fear of missing gains, and that fear is stronger. So more money flows in. Prices rise faster, and here's the trap. Rising prices create their own justification. When your neighbor made 40% last year in tech stocks, it's not speculation anymore. It's evidence. Proof the strategy works. Marx calls this phase the shift from skepticism to acceptance. It's the moment when buying no longer feels risky, it feels smart. And that's when the cycle accelerates. Because now it's not just retail investors, it's institutions, pension funds, endowments, the smart money. They have models, stress tests, risk committees, and all of those systems are telling them the same thing. Everyone else is buying. If we don't, we'll underperform. So they buy. And prices don't just rise, they soar. By the time you reach the top of the cycle, something absurd happens. The riskiest assets offer the lowest returns. Think about that. The moment when everyone believes an investment is safest is precisely when it's most dangerous. Because the price has been pushed so high that future gains are mathematically impossible. In 2006, mortgage-backed securities were considered bulletproof, AAA rated, backed by real estate, which everyone knew only went up. Pension funds bought them for safety. 18 months later, they were worthless. Marx has a phrase for this. The biggest risk is the belief that there is no risk, and you can see it in the data. In early 2000, the Nasdaq was trading at a price-to-earnings ratio of 175. To justify that valuation, internet companies would have needed to grow earnings by 40% annually for a decade. None of them had earnings. People knew this. They said it out loud, and they kept buying. So when does it end? Not with the announcement, not with a catalyst you can see coming. It ends when the last buyer buys. Because markets need new money to keep rising. When everyone who's going to buy has already bought, there's no one left.
Hear me now.
Prices stall, and stalling feels like falling. The first sellers aren't panicking. They're taking profits, being smart. But their selling pushes prices down, and that gets noticed. Other investors, the ones who bought recently, see red in their portfolios. They don't panic either, not yet. They tell themselves it's a healthy correction, a buying opportunity. Some of them even buy more, but prices keep falling. And here's where the cycle completes. The fear that disappeared during the boom comes back, not slowly, all at once. Investors who bought at the top suddenly realize they overpaid. The assets they thought were safe now feel radioactive, and the only thought in their head is, get out. Selling becomes a stampede. Prices collapse, and the investors who believed they were being rational, following the data, being disciplined, realized they were doing what everyone else was doing. Let's be precise about what this costs. In the dot-com crash, the Nasdaq fell 78% from peak to trough. If you invested $10,000 in March 2000, you had $2,200 in October 2002. But here's the worst part. To recover from a 78% loss, you don't need a 78% gain. You need a 355% gain, because you're starting from a smaller number. It took the Nasdaq 15 years to break even. Some investors never recovered, not because they couldn't, because they sold at the bottom, when the pain was unbearable and holding on felt like financial suicide. And this happens every cycle, because the cycle isn't just about prices, it's about psychology. Optimism turns to euphoria. Euphoria turns to denial. Denial turns to panic. Marx says most investors experience this as a surprise. But it's not a surprise, it's a pattern, and the pattern is always the same. Here's what makes the cycle so vicious. The behaviors that feel safest are the most dangerous. Buying when everyone else is buying feels smart. You have social proof, validation, expert consensus. It's comfortable. Selling when everyone else is selling feels responsible. You're cutting losses, protecting capital, being prudent. But both moves are exactly wrong. The safest time to buy is when it feels terrifying. When assets are hated, cheap, and no one wants them. The safest time to sell is when it feels greedy. When you're watching your portfolio climb and thinking, maybe just a little longer. Doing this requires ignoring your instincts, ignoring the crowd, and tolerating the very real possibility that you're early. That prices will keep falling after you buy or keep rising after you sell. Most investors can't do it, not because they're dumb, because they're human. So where are we in the cycle today? Marx doesn't make predictions, but he watches for signs. And the signs aren't about price levels or economic data. They're about behavior. Are investors cautious or confident? Are they demanding high returns for taking risk or accepting low returns because they're afraid of missing out? Is skepticism normal or is skepticism mocked? In late 2021, you could watch TikTok videos of teenagers giving stock tips. SPACs were going public with no revenue and billion-dollar valuations. Crypto investors were taking out loans to buy more crypto. That's not analysis. That's a sign. By late 2022, those same assets had fallen 60, 70, 80%. The cycle turned, and the investors who bought at the top, convinced they were early to a revolution, were underwater. Now in early 2025, things feel different again. Markets have recovered. AI is the new story. Big tech is hitting all-time highs, and investors are starting to feel comfortable again. Which brings us to the question Marx would ask. Is this comfort justified, or is it just the next chapter? The reason the cycle repeats isn't because investors are stupid. It's because the cycle exploits the way our brains work. We're wired to find patterns, follow crowds, and avoid loss. Those instincts kept us alive for millennia. But in markets, they're liabilities. When everyone around you is making money, your brain interprets that as safety. When everyone is losing money, your brain interprets that as danger. Both interpretations are backwards. And here's the deeper problem. The cycle is self-reinforcing. Rising prices make people optimistic. Optimism makes them buy. Buying raises prices, which makes them more optimistic, until it doesn't. There's no external force that stops it. No regulator, no algorithm, no genius investor who steps in and says, "Okay, everyone, the party's over." It stops because it runs out of fuel, because the math stops working, because there's no one left to buy. So can you beat the cycle? Marx would say no. And also yes, you can't predict when the cycle will turn. You can't time the market. Every investor who thinks they can is fooling themselves. But you can survive it by understanding where you are, by recognizing euphoria when you feel it, by asking when everyone agrees with you, what am I missing? The investors who survive crashes aren't the ones who saw them coming. They're the ones who weren't fully invested at the top, who kept cash, who didn't leverage, who were willing to look stupid while everyone else got rich. And that's the real lesson. The cycle doesn't punish ignorance. It punishes certainty. Because the moment you're certain the market will keep rising, you're vulnerable. The moment you're certain it will keep falling, you miss the recovery. The survivors live in the uncertainty. They accept that they don't know. And they build their portfolios accordingly. That programmer who turned down 12 million in stock options didn't have inside information. He didn't predict the dot-com crash. He just knew that when everyone around him was getting rich without doing anything difficult, something was wrong. The cycle doesn't care if you understand it. It'll run you over either way. But if you do understand it, you'll stop asking when the crash will come and start asking a better question. What are you doing right now that only makes sense if nothing ever goes wrong?